Video number 3 of the order flow module, where we are going to be discussing the hierarchy. Now, in this video, I want to discuss and take you with me essentially into my perspective, into my mind, and how I view order flow and how it essentially also was created in the first place. Now, we have gone over the base of order flow and the understanding of order flow in the first few videos as well, but it's also based on different concepts that we are already use as well. So that's what I want to touch on in this video. Now, as well, we're going to go over the hierarchy. Number 2, biggest mistakes. Number 3, market structure. Number 4, order flow. Then candle signs. Then number 6, candle signs, order flow, and market structure. And number 7, homework. So there's quite a lot that we need to go over right here. But first, let's focus on the hierarchy. The 3 concepts that you see right here are essentially linked to each other. And what I mean by that is every concept that you see is based on the previous concept. So order flow is essentially based on market structure, or at least a part of market structure as well. Candle signs is based on order flow, which is then also based on a part of market structure as well. It's all correlated with each other. The 3 concepts you are seeing here are essentially one concept. And that's important to understand, but that's an understanding that we're slowly going to build towards, because that's how I view it in my mind. And I think to understand order flow to the best of our abilities, you need to understand it from my perspective as well. So if we talk about a basic hierarchy, then we talk about the following. It starts with market structure right there, but we're going to dive into as well how it doesn't have to start with market structure. But let's first make it simple for ourselves and say it starts with market structure. Okay, market structure right there with intermediate highs, intermediate lows, it gives us an overall bird's eye view of the market. So a bigger understanding of if we want to continue higher or if we want to continue lower. But market structure in itself, and what I always found, is that market structure doesn't necessarily give you a whole lot of accuracy. And in trading, accuracy is quite important because you can't just simply click buy or sell and it's 50-50 up or 50-50 down right there, because you need some accuracy, because we use a stop loss, because we use a take profit. We need to take into account the win rate in comparison to our overall risk to reward ratio. So there needs to be a form of accuracy in our trading. That accuracy, that's where I discovered, and what I essentially taught myself, is order flow. Because order flow gives us, and it's correlated to as well market structure, but it gives us a lot more accuracy to understand what the most recent lags are actually doing. Then from that order flow understanding, if we want to have even more accuracy, we can dive into candle signs. Now, candle signs is essentially order flow on a different time frame. Order flow is essentially market structure on a different time frame. Market structure is essentially order flow and candle signs also on different time frames. So there is a correlation, but it's also all the same thing. Now, that might seem very confusing at this moment in time, but let me explain that a little bit more clearly later on. And before we do that, let me also give you an example of how I view this. So right here, we are on ES and we are on the weekly time frame. Now, if the first thing we want to discuss with the hierarchy is market structure right here, then we have this intermediate high, we have this intermediate low right there, we have this next intermediate high right there that was created above the previous intermediate high, creates an intermediate low right there. Then we also have this intermediate high and this potential intermediate low. So overall, we can determine right here that the bird's eye view, so the overall higher time frame trend, is simply said still bullish. So we can expect higher prices. So ideally, we want to have order flow in alignment with that as well. We want to have order flow in alignment with our market structure. Now, if we talk about market structure right here, then we could argue, well, you can also use market structure to enter, for example, something like this, to cover an intermediate low right there, to then continue higher. But it doesn't give us a very great deal of accuracy. First of all, our stop loss will be a lot bigger as well. But next to that, our entry is not even that accurate. So if we want to accurately enter, we can then start looking at something like order flow right here. So actually seeing what the most recent price action is doing. That will give us essentially an updated view right here on what price is actually doing at that moment in time. So here we have the most recent weekly order flow lag. Now within that order flow lag, we have this fair value gap and we have this fair value area right here. So what have we just done? We have zoomed in on price. And when we zoom in on price action, we will now get to order flow. And that zooming in allows us to understand right here what we can actually continue higher from. So if we now understand we can continue higher from this, and we now place our stop loss below the order flow leg, that already gives us so much more accuracy. But if we now zoom in even more and we take a look at the recent candles, then from this fair value gap, from that fair value area, we see candle signs right there respecting the fair value gap and the fair value area. So understanding when we can actually continue higher right there gives us even more accuracy. Now, this is essentially the hierarchy. So market structure, zoom in, order flow, zoom in even more, and you get candle signs right there. And they're all based on each other, essentially. Every concept is based on each other. So to visually take you with me in how I view this is, again, the hierarchy right here. If you were to zoom in on market structure, you would get something called order flow. Now, order flow is also based on market structure right there. Then order flow, if you were to zoom in on that right there, you would get something called candle signs. Now, candle signs is also based on order flow and thus also based on market structure. Now, the cycle repeats because here, the example we just had on ES right there, it doesn't end there. Because if you now zoom in on candle signs and you were, for example, to go down time frames, instead of the weekly, you were to go into the 4-hour time frame, you start all over again. Because you start again with market structure. So zooming in on candle signs, you get back to market structure and order flow, and then eventually you get back to candle signs again. And the cycle can repeat even more, because if you go down time frames, it's the exact same thing as well. So eventually, it all comes down to understanding how they are linked to each other and also understanding what time frames we want to use and how to navigate those time frames. That's very important. But first of all, let's understand also the biggest downfalls we have when it comes to order flow. Because when people learn about order flow, it's a beautiful concept. Don't get me wrong, order flow is my baby, essentially, as I always like to say it, because I just feel very connected to order flow. It's my baby, essentially. So when we learn about order flow, we tend to get very excited to dive into the market and think everything will be all right because I have order flow by my side. But it's a little bit more nuanced to that. So one of the biggest downfalls that I see quite often is that it's switching bias too fast. So if we take the example of ES again, then right here, we were on the weekly time frame and we understood that the weekly time frame overall was still bullish based on market structure, based on the higher time frame trend, etc. That these continuations lower right there, they are nothing more than overall a simple retracement to then continue higher and continue the overall higher time frame trend as well. Now on the daily, what we actually saw earlier on is that daily order flow right here actually got confirmed to be bearish at this moment in time. But we need to understand that this daily bearish order flow, can that be traded? Yes. Can this be traded all the way to back to zero essentially? So all the way to continue lower? No. Why? It's not in alignment with what we had on the weekly and the monthly time frame, where the overall market structure, and even on the daily right here, the overall market structure is still bullish. So that's very important to understand, that you don't want to switch that bias too fast. Now, a good example of this is also in very recent price action right here. We had this weekly order flow lag and this weekly fair value gap right there, which we can continue higher from. If we zoom in on the 4-hour time frame right here, then even if we take a look at the 4-hour market structure first, we see that we have the following. We have this intermediate term low, intermediate term high, intermediate term low, intermediate term high, and now we are creating an intermediate term low. Where do intermediate term lows get created in a bullish overall market structure environment? They get created at higher time frame discount arrays. Why again? Because we are overall trading higher time frame levels, what we determined in the previous video. Because again, institutions are trading higher time frame levels. So from higher time frame level to higher time frame level. That's simply for us, those order flow lags. So if we take a look right here again, and we see that 4-hour market structure will make it quite difficult to accurately say what we want to continue higher from at this moment in time. we don't even retrace back into the 50% level. So a lot of people that use the 50% to make the argument that it's discount, that's not necessarily how the market works. So right here, if we want to continue higher, we zoom out a little bit right here to determine order flow. Okay, we have this weekly fair value gap right there. So bullish market structure on the 4-hour, bullish market structure on the daily, on the weekly. We have weekly bullish order flow right here, bullish fair value gap, which we can also continue higher from. So on the 4-hour, in most recent price action, what do we have? Bearish order flow right there. Actually confirmed to be bearish, to potentially continue lower. Is this standalone? And what I mean standalone is that this bearish order flow doesn't have anything else supporting the ID. Is that bearish order flow right there very good order flow to say, now we can continue lower from that? No, because we just determined even market structure here on the 4-hour, everything else is simply still bullish. So we can continue higher. So we want to look for those bullish order flow legs, these fair value gaps right there, to continue higher from. Now that's very important to understand because, like I mentioned, when people start learning about order flow, the temptation to now go into the 4-hour or even below that 1 hour, 50 minute, just follow every single order flow leg and thinking it will be all right. That's essentially neglecting the previous video that we made, because you don't understand that order flow is also based on institutions, and institutions trade from higher time frame level to higher time frame level. So those contexts, those higher time frame context areas are very important. So even if you're a flow trader, it is very important to understand that 4-hour order flow in itself is not necessarily enough. Why? Because the 4-hour is less important than the daily, weekly, and the monthly. And the daily, the weekly, and the monthly is where we will see true institutional action, where we will truly get institutions to buy at higher time frame levels right there, to then continue higher again towards the next higher time frame level right there to offload their positions, what we talked about in the previous video. This is also why for filtering process traders as well, I mention quite often in previous enrollments, previous modules, the 4-hour alone is not enough. You also want to have the daily, the weekly, or the monthly if you are trading from a 4-hour level. So if you're just trading for 4-hour levels, again, you ideally want to have a daily, weekly, monthly level before that supporting ID. So for example, this 4-hour level is perfect because we're coming from this weekly higher time frame level right there to potentially still continue higher as well. That's important to understand. Now, the second downfall or mistake we could argue is the following: lost in order flow. Now, this is very similar to what we just went over in the exact same example as well. Because if you just start following 1 hour, 4-hour order flow, it's very easy to get lost. Because again, you need to understand where order flow tends to hold. 1 hour order flow, it unfortunately is not a utopia where bullish order flow holds perfectly to then switch perfectly to bearish order flow again. It doesn't work like that. You have to incorporate a lot of different time frames as well. You have to understand when we are consolidating, etc. And then if you were to only follow 1 hour order flow, expecting it to be a utopia where it will hold perfectly, etc., then you get lost in order flow. And that's of course not something we want, because then we'll not take into account the higher time frame trend anymore. And that is very important. Essentially, what it comes down to is understanding what is the higher time frame trend. If the higher time frame trend is bullish, then simply waiting for bullish shifts in order flow to continue higher overall. So aligning order flow with the overall higher time frame trend as well. Very important. Okay, now let's move on to market structure itself. So right here, the first thing I want to discuss in market structure is again the bird's eye view. Understanding that market structure is that bird's eye view. So what I mean by that is market structure is the big brother. It's everything essentially. It's what the higher time frame, the overall trend direction will eventually do as well. And when I look at a bird's eye view for market structure, I always call it, you want to focus on those outsiders. You might have heard me say that before in different enrollments and modules as well. And what I mean with outsiders, those are the intermediate term highs and intermediate term lows. Intermediate term highs, intermediate term lows are the most important when it comes to market structure, because that tells us the bird's eye view on what the overall higher time frame trend and the overall direction is of the market, which highs and which lows we can expect to hold, to be protected before we continue higher, before we continue lower again. But that again will not give us a great deal of accuracy, because those intermediate term highs, those intermediate term lows, yes, it's accurate as in we can understand which high and low is protected, but to enter, to place a stop loss, etc., not that great. Now we could argue this is where short-term highs and short-term lows come in. Short-term highs and short-term lows is essentially what order flow also is. Intermediate term highs and intermediate term lows is essentially also what order flow is. Because we just looked, and on ES, we looked at a weekly order flow lag that was bullish. What was that on the 4 hour? That was intermediate term low towards an intermediate term high. Now let me show it to you again. On the 4 hour right here, we mentioned we had this intermediate term low right there, and we had this intermediate term high. So on the 4 hour, this is market structure, making it quite hard to determine what we want to continue higher from right there. But on the weekly, this is also simply said order flow right there. So the same low is a short-term low, essentially, is an order flow low right there. And this same high is an order flow high, essentially, right there, before we can continue higher overall. So it's dependent on what time frame you are also looking at. Now, those short-term highs and short-term lows, if you understand market structure itself, is also quite vague, as in it's not super clear, it's not very well defined. If you follow any market structure lessons on, well, except for mine, I would argue, if you follow any market structure lessons on YouTube, or you get introduced to market structure, they just tell you and they just talk about swing highs, swing lows. It again doesn't give a great deal of accuracy. So instead of focusing on short-term highs, short-term lows, we want to replace that with the understanding of order flow, because order flow is a little bit more defined, and order flow is a better understanding, which overall gives us more accuracy as well. If we then combine it with the understanding of the bird's eye view of market structure, intermediate term highs and intermediate term lows as well, which will give us the overall direction of the market. So again, that leads us to order flow. Now, order flow right here is an increased accuracy, what we've been touching on and emphasizing on quite some time right now. So I don't think we have to go over that anymore, because we also showed the example with the weekly time frame and the 4 hour time frame. The weekly time frame, when we look at order flow, it gives us a lot more accuracy what we can actually continue higher or lower from. Now, when we talk about order flow, we ideally want to have it in alignment with the overall market structure as well. The reason for this is the exact same thing that we talked about with the biggest downfalls. And that is getting lost in order flow or switching bias too fast when we only take into account order flow. So market structure is essentially quite a simple way of looking at the market, but it avoids us from switching bias and from getting lost in that order flow, because we understand, okay, market structure has overall been bullish on the higher time frame. Then all I want to do is simply wait for order flow to transition and to become bullish as well, to then follow the bullish order flow to continue higher towards the previous intermediate high that we created, the essential target that we have. That is essentially what we want to focus on to avoid those mistakes that we make with order flow as well. Then that order flow, that leads to, of course, candle signs, because order flow is essentially candle signs on a different time frame. Because if you were to dissect candle signs, it's essentially a long wick at the bottom is what? A long wick at the bottom is order flow lags going lower to then order flow lags going higher again. And that, if you zoom out and look at it from one time frame, from one candle perspective, that's candle signs. So right here, when we talk about candle signs, we essentially also look at market structure and order flow. So all these concepts, these three concepts that we use, are essentially all the same thing. Now, again, I'm going to explain that a little more clearly as well later on in this video, but that's the perspective I have of these three concepts right here, that they're essentially the same thing. Now, right here, when we talk about candle signs, we again want to ideally have it in alignment with order flow as well. So when we talk about that hierarchy, to simplify the hierarchy, we have market structure. If that's bullish, we ideally want to see bullish order flow as well. If we have order flow, if that's bullish, we want to see a retracement into that order flow lag to then also have bullish candle signs, bullish to candle rejection as well. When those three are in alignment with each other on, for example, the weekly time frame, that's perfect. That's where we can then confidently trade to say, okay, this is going to actually continue higher. That's high probability. Now, if we move on and we now flip it. So instead of market structure, order flow to then candle signs, if it's the same concept, we could also make the argument that we can do the following, where we can go from candle signs to order flow to market structure. Now, my goal with this is, again, not to confuse you. I hope I'm not doing that. But my goal with this is to get you to an understanding how you can flow through the market on different time frames, and you're constantly understanding of what candle signs is doing on the time frame above you, what order flow is doing on the time frame below you, what market structure is doing on this time frame and the time frame below you, above you, whatever it is. So being in a constant flow of understanding what all the time frames are doing connected to each other based on the concepts that we have right here. And the concepts that we have right here are essentially these three concepts right here, because they're the same concept, but you look at it from a different lens. Now, right here, like I mentioned, it's essentially all the same thing. It's the time frame that makes it different. So let me give you an example of that. Because if we take a look at candle signs, and let's say our analysis starts off with weekly candle signs, that's perfectly fine. That could be doable right here. So you understand we are coming from this weekly fair value gap right there. Then we have this bullish up candle right there. So candle signs is telling us the next candle might also want to continue higher towards that premium array right there. Perfect. Now, if you go down the time frame, then what does this turn into? This overall turns into order flow, and it also turns into overall market structure, because now we are dealing with order flow lags right here within that candle signs again. And now we're also dealing with market structure right here within that candle signs as well. So if we take this even a step further and we continue higher eventually right there, and we take a look at this fair value gap, the same thing applies. So this first candle from this fair value gap right here is what? It's an up candle. So based on two candle rejection in candle signs, which we'll go over in the candle signs module later on, based on this two candle rejection right there in candle signs, we can continue higher right now. So we can expect the next few candles to be bullish. Now, if we were to zoom in on this candle and we were to, for example, go into the 15-minute time frame, we were now to look at order flow. So here we are actually looking at order flow right there from those order flow lags to potentially continue higher from those. Now, at the same time, we are now also looking at market structure right there. Now, this is the same thing that we did, just reversed essentially when we started off with the weekly time frame right here, and we were taking a look at weekly market structure first, that we see right here with these intermediate term highs and intermediate term lows. Right there, and then right there, and right there, and then eventually continuing higher to then going to zoom in and to look at order flow, to then look at candle signs. But now we have reversed it again, where we look at this candle signs to then order flow, to then look at market structure again. Now, this makes it, for me, extremely interesting. But it also is arguably the most difficult part about understanding the concepts, because I think understanding the concepts alone is quite an easy process, as in I can explain to everyone what order flow is. But making them connect with one another, that's the difficult part, essentially. Now, I always like to compare this to a theory by a genius that we had in the past, and that is Albert Einstein. Now, Albert Einstein had a relativity theory. And relativity theory, you've heard me mention that before, most likely if you follow my content as well. And I don't necessarily want to explain the relativity theory very much in depth. You don't necessarily need to understand it very in depth. But if you understand a little part of the relativity theory, then you also understand what we're aiming at right here with these three concepts. So I'm just going to read a sentence right here. Do you need to fully understand it? Again, not necessarily. But the sentence is the following. So in Einstein's relativity, time and space are relative depending on the observer's motion and position. Now, I don't want to turn this into something rocket science and space and stuff, but what I'm aiming at right here is this is essentially the same thing that we have with the three concepts that we have right there. So time and space are relative depending on the observer's motion and position. Now, the observer is you. Depending on what time frame you are looking at, that is then going to determine as well what overall concept you are looking at. So we can look at the same time frame, but we can also understand the different concepts that we have right there. So the relativity theory right there, essentially what I've mentioned in the past as well, is whatever time frame you are looking at, that's also then, so the core concepts, they are constantly the same. But depending what time frame you are looking at, it can change a little bit. So that makes it very interesting, and that makes it quite similar or a valid comparison overall to something like a relativity theory, which is, again, quite interesting to me at least. Now, right here, then there's one thing we can conclude from all this. And that is the most difficult, because the most difficult is navigating the time frames then correctly. So not getting stuck up on, okay, 4 hour needs to be order flow. No, 4 hour can also be market structure, but 4 hour can also be candle signs at the same time. It's just depending on how you overall look at it. It's becoming a master of navigating those time frames. That's essentially all trading is, navigating those time frames correctly. And when you can navigate those time frames correctly, then you will also understand the three different concepts that we have right here, and how on every single time frame, you will have market structure, you will have order flow, you will have candle signs right there. But if you zoom in, you will again have a different perspective with it. And if you zoom out on that market structure on one time frame, it will become candle signs. So it's all about navigating those time frames. And that is arguably the most difficult part, in my opinion, trying to learn that and constantly switching between those time frames and seeing how they connect with each other. Because if you see how they connect with each other, you also understand how these different concepts connect with one another. Okay, so I want to end it with one visual right here before we dive into the homework as well. And this is essentially all we do throughout the mentorship. And this is essentially what I define as trading right there. You have market structure, you have order flow, and candle signs. Three different concepts that are essentially the same thing, that can flow, that can interchange between each other essentially. So they can flow towards one side and also towards the other side. It doesn't matter, because it's essentially all the same thing right there. It just depends on how you are navigating the time frames. Now, to make this a little bit more clear for yourself, because I can understand this is quite a difficult concept to fully grasp, but it's very important to understand, because this aligns with the overall idea of having good order flow or bad order flow. Then, this is the homework. Determine on every time frame the following. First, market structure, then order flow, and then candle signs. But what I would like for you to do, and what the main objective for this is, and what the main homework is do you truly understand the correlation between the three concepts? So how those time frames are connected to each other, and how those concepts are then also connected to each other. So when you're looking at order flow one time, you are looking at candle signs on the other time. When you're looking at a monthly candle and you see a big rejection, or you don't see a big rejection, and if you go down time frames, how is that connected to order flow and market structure right there? That's the main goal, because if you understand that, you also understand my perspective and what this is all based on as well, to get a more accuracy and a more accurate idea of what the market wants to do. All right, perfect. Thank you.